negotiate something, they all need to be included to the extent that that's possible.
Okay. Now, what if you have an investment property? Is a foreclosure different related to that, or a short sale, as compared to your principal residence?
Well, the rules are going to be different because with a residence, you have the opportunity for the mortgages to be non-recourse. We haven't got into that discussion quite yet, but with the investment property, if it's a rental property or commercial property that you've bought as an investment, the procedures are going to be the recourse debt procedures. In other words, you still would probably have a trustee sale, maybe a judicial foreclosure. You might be able to negotiate a short sale on that kind of a property. But the type of debt that you would be dealing with would not be personal residence debt. Mm-hmm. And there are all kinds of rules that apply to personal residences that we know about from all different parts of the tax law. And some of the newest legislation that's been passed, Debt Relief Act and things like that, those all apply to primary residences and personal residences, but they don't necessarily apply or don't apply to these other kind of properties.
Mm-hmm. Okay. All right, so let's get into this question now about recourse debt and non-recourse debt. So what is the difference? What is recourse debt? What's non-recourse debt? And if you have a mortgage, how can you tell whether it's recourse or non-recourse?
Right, that's a great question because you probably can't tell by looking at it. Because there really are different kinds of recourse versus non-recourse debt. So let me say, first of all, that most debt is, on its face, recourse debt, unless it specifically has been negotiated to be non-recourse debt. And that does happen. It happens particularly in commercial transactions. But if it is specifically non-recourse debt, then it will say somewhere in the body of the documents that it's non-recourse debt. There's another type of non-recourse debt, though, that arises from the kind of property it is and the kind of money that it was borrowed. And what I mean by that is there are 12 states that have some type of anti-deficiency statute. And I don't know the laws of all of them, but I know the laws of a couple of them. And in California, for example, this applies to a property that is 1 to 4 units and the borrower-buyer intends to occupy. There's intent mm-hmm. is involved. Mm-hmm. Intends to occupy at least one of the units. Mm-hmm. If it's a single-family house, of course, it's the whole unit. And then the money also has to be what's called purchase money. Mm-hmm. So if all of those things are true, the document itself doesn't say anywhere in it non-recourse. But by function of the anti-deficiency statute, that kind of borrowing is non-recourse. Mm-hmm. Okay, so what's the difference between recourse and non-recourse? Recourse debt means that if the property is sold for less than the mortgage, or if it's foreclosed and it's not worth as much as the mortgage, that a lender has the opportunity to try to recover the difference between what the property was worth and what the mortgage was, with the mortgage obviously being more than the property is worth. So they have recourse to try to get the deficiency amount from the borrower. With non-recourse debt, either by negotiation or by statute, the lender is left with just the collateral. When they sell it, that's all they can get. They can't get the balance of it. So with single-family residences in 1 to 4 unit properties in California where the owner intends to occupy, if the money is used to purchase the property, then we call that non-recourse debt. But what it really means is the anti-deficiency statute of California applies to that property. Mm-hmm. Okay.
Okay. So we were talking about these different states. So a question is, we have a lot of people in California that have invested in properties in other states. Are the rules for these anti-deficiency statutes, and they're not the same for all the states, I guess?
No, they're not the same. I haven't read all of them. I've had clients with property in California and property in Arizona. And the Arizona statute is quite different. It's actually in some ways more liberal. It only applies to 1 to 2 unit residential property, mm-hmm. so it's a little less liberal in that sense. It doesn't apply up to 4 units. But the requirements there are like the property needs to be 2.5 acres or less, and it needs to be utilized as a residence. And the difference there is, and these are legal words and it doesn't sound like a big difference, but the difference is in California, the borrower has to intend to occupy, meaning the borrower himself has to intend to occupy. But in Arizona, because of the way they worded their statute, if the property is utilized as a residence, it could be utilized by a renter. So there are people who can buy rental properties in Arizona, and they're single-family residences on less than 2.5 acres, and they can still qualify under that state's anti-deficiency statute. So again, depending on where the property is, there may or may not even be an anti-deficiency statute. If there are only 12 states that have it, the most don't. So in most states, these loans are considered to be recourse loans. And each state law would have to be looked at specifically to see how the property qualifies and if it qualifies.
Right. All right. So now you're in trouble. You can't make your mortgage payments. You get laid off. When do you consider filing for bankruptcy?
Well, I really think if you can't do anything else, by that I mean if you aren't able to renegotiate or modify your loan, if you aren't able to do a short sale and get rid of all the mortgages at once, so you've made your effort to deal with the property and protect your credit, and you have to do one of these other things, you think, like foreclosure or let it go through trustee's sale, I think you should talk with a bankruptcy lawyer before you do that. I think that's good advice, because the other way that people can get out of a tax liability or some of these debt liabilities might be through insolvency or through bankruptcy. So for example, these second or third mortgage holders who would maybe pursue a deficiency judgment, they become unsecured creditors, and bankruptcy can take care of that. So I would say you should consult with a bankruptcy attorney as part of the process, at least not necessarily to file bankruptcy, but to get an opinion about what they might be able to do to help you.
Okay. All right. Well, I think we've covered most of what we probably can in the time that we have allotted to us today. So I thank you, and we're going to have another discussion where we're going to focus more on the tax aspects of these things. But meanwhile, we're going to have some contact information at the end of the show if you would like to get in touch with Bill Mahan. Also contact information for myself. Bill has a website. I believe it's www.mahan.law.com. If it doesn't work with the dot in the middle, then try it without. My website, www.financialinsiderweekly.com. And also, I'm looking for guests for this show. So if you know somebody that you think would be an interesting guest, I'd appreciate it if you get in touch with me and let me know. So with that, thank you, and I hope you'll join us with our next show, Wednesday afternoons, 4:30 p.m.